Hey all, welcome to ShareTreck. This is Raj here. Good morning. I hope you have a great day. The market is still looking good. It's very confusing looking at the historical trends for the last 2 weeks of September and the month of October. And also the historical fact that most of the time the Fed has been behind the curve and interest rate peaks followed by cuts have always been followed by recession. So is it going to be a soft landing this time, or is it going to be recession? Those are the questions that linger. And the other aspect is also the worsening geopolitical situation. Will it create an impact on oil prices and supply chains and rekindle the inflation? Those are all the main concerns that I have at the back of my mind. I would like to hear from you guys. If I have missed out on something, please put it in the comment section. That said, let's have a look at the disclaimer and get started. We are starting today, as always, with all the indices futures showing green. Even oil prices have gone up. So overall, there is greenery all over the place. And some of the headlines that catch my mind is JP Morgan CEO Jamie Dimon wants geopolitics is getting worse. I think in a way the US has been preoccupied with the election and also the distraction from Trump. So overall, US has not been looking outward. And there has been a free-for-all going on globally. We have the Israel conflict, which has expanded into Lebanon. And then we also have the Russia-Ukraine war going on for quite a while now. So things are not looking that great in a geopolitical sense. So I agree with Jamie Dimon on that. That could also have a lot of risks for the market, as I mentioned at the opening. And then we got another heading out here, which says Fed jumbo rate cut puts US on track for a soft landing. It's anybody's speculation. They may say it's a soft landing, but I would like to see it before I believe it, because in the past, I think 99% of the time, Fed rate cut cycle has started just before a recession. We'll see what happens in the next 4 or 5 weeks. In the long run, the markets have always been bullish. You can see that it's always gone up. So for long-term investors, these are just noise. No need to worry, but it's more for a speculator. And this channel, we are all looking as long-term investors, so we won't worry too much about it. Treasury yields rise as investors await Fed speeches and economic data. This is good for the mortgage market. This is good for the housing market, as the mortgage rates will be lower. So I'm looking at it very carefully and thinking that that could be another pop for the economy overall. And then we have this headline here: Trump threatens 200% tariffs if John Deere moves production to Mexico. Friends, as investors, as retail investors, I want to share with you what I think about tariffs. Tariffs are basically going to increase the price for the ultimate consumer. Look at it this way. Let us say we have Trump's golf course, and Trump is charging $15 per hole, let us say, per round of 18 holes. These are all hypothetical numbers, okay? Now, let us say the city levies a tax of 2% on Trump. Then is Trump going to just absorb that cost? He's going to add it and put it on the tab for the customer. So tariffs are exactly like that. If you say you're going to put tariffs on all Chinese goods and Korean goods that are imported into US, then look at all the things that they export. You have the washer dryers, you have the television sets, you have the automobiles. All of them will have tariff. And the tariff, let us say, just like Trump is saying he's going to put 200 on John Deere, let us say he put 100% tariff on all imports from China and Korea. Then you can imagine that the car prices, the television prices, and everything is going to go up, because the importer will have to pay more. Japan or Korea or China are not going to absorb the tariff. The business model doesn't work that way. It's as simple as that. He may call whatever he may call it, but it's basically a tax on the end user consumer. So please keep that in mind when you look at such proposals. And when those kind of things happen, there are two or three different things that will happen. One is the local manufacturer will find that they can increase the price on their television television sets and cars that they have manufactured locally because imports are more expensive. So the profit margin for local producers will go up. That does not directly translate into more employment. It basically means that the CPI is going to go up, consumer price index will go up. The second thing that happens is that the incentive for local manufacturers to come up with superior products, more efficient products, do R&D, all of those things go away because it's easy profits, heavy profits. So the manufacturers do not do any R&D. They save the money on the R&D, and they will keep the production in a limit so that they can have maximum margin for whatever they are producing. So it's not at all good for the country, and also it can cause other countries to put tariff on American exports, and America is a net exporter. America exports to all over the world. Look at companies like Microsoft, Oracle, Tesla, and so many huge international brands like IBM. They are all exporting worldwide. So if other countries start putting tariff on them, that's going to create problem. So these are all simplistic, populistic approaches, but we should not fall for it. That's my opinion as a retail investor. Guys, you put what you think in the comment section so that I can get an idea of how you are thinking about it. So those are the main headlines that I'm looking at. Now let's go to the economic calendar. There is a Bank of Japan governor speech that's likely to happen. I checked the internet. I couldn't find any of those speeches. So I believe that it's yet to happen. So there'll be some clue whether Japan is going to be hawkish. If it's going to be hawkish, then you can see some remnants of the unwind trade pull the market down. And after that, I think we are looking for the GDP growth rate. That's a very important data point. Durable goods orders month over month. Those things are going to be very important to look at, and they may give a clue of where things are going. At 9:20 a.m. on Thursday, we also have Fed Chair Powell's speech and Fed Williams' speech. So those things can also, there's a bunch of Fed speech. There are around 4 of them speaking, and those things can have an impact on the market. And finally, we have on Friday, which is the motherlode core PCE price index, personal income month over month, and personal spending month over month. Those are the things that can move the markets, and also options unwinding on Friday. So we are not out of the woods yet. We have to be vigilant. And if you look at the stock market heat map, you can see that a lot of money had gone into the defensive sectors yesterday. And today, the question is, are we going to have rotation back into the Magnificent Seven and the AI and the technology stocks? That's the question that we are looking at. I think that we'll have rotation again because we are going to be on a holding pattern until Friday. Probably month of October might be worse, but we had another indication that I had shown the other day, which says October is the best month for NASDAQ. We'll unravel those things and learn something. Amazon is down 0.68%. Microsoft is down 0.25%. AMD is up 0.16%. Palantir is down 0.37%. FNGU is up 0.04%. AVGO is down 0.14%. Oracle is down 0.09%. Micron is up 1.16%. Cloudflare is up 0.41%. Applied Materials is up 0.33%. Nvidia is up 0.15%, still struggling to break through this diagonal line of resistance out here. Qualcomm is up 0.50%. SMCI is up 0.55%. ARM is up 0.46%. ASML is up 0.77%. There is a gap fill that needs to be done. I think it can be attempted today. And we could have some resistance from the 50-day exponential, which is this orange line, which is sitting at 822.96 right now. Intel is down 0.04%. And then we have SMH, which is the semiconductor ETF, up 0.44%. So to me, it seems like there is a preference towards semiconductors as opposed to AI and technology. So we can expect semiconductor stocks to go up today, and it's on a bull track. So that's looking good. Let's go on to look at genomics. PSCB is up 0.57%. IMTX has got no trades pre-market. Bluebird Bio is up 2.45% pre-market. DNA is down 1.40 pre-market. Prime has got no trades pre-market. Allogene is down 1.12% pre-market, and it still has support from this diagonal line. And we have Iowa, which is up 0.93%. mRNA is up 0.70%. Beam Therapeutics is up 1.05%. Intelia is down 0.05%. Editas has got no trades pre-market. Altimmune is up 1.81%. And Caribou Biosciences has got no trade pre-market. CRISPR is up 0.56% pre-market. And Bionano Genomics is up 0.30%. ArcG is up 0.39%. Grail has got no trades pre-market. Illumina is up 0.32% pre-market. Verve is up 0.20% pre-market. Now, I've got a new index out here. I'll talk in detail about it later, but CRISPR is underperforming the QQQ, and CRISPR is overperforming the ArcG index. So those are the 2 pointers that you have there for the overall health. And friends, that brings me to an end of this day's pre-market session. And my closing impressions with the pre-market session is that we still have to be careful. There are geopolitical issues out there which are yet to be resolved, and any of them can trigger off oil price hike or a supply chain disruption, and that can upend all the progress that we have made so far, and the dropping interest rate can probably change. So that's one big risk that we have to keep in mind. The second takeaway basically is that most of the times, almost 99% of the times in the past, by the time the Fed had started the rate cut cycle, it had been too late, and the rate cut has been followed with recession. Is it going to be different this time? That's the other risk factor that you have to keep in mind. And if a recession comes in, then all the valuations of the stocks are likely to fall, and that could be a long period of time before which you can recover all those monies. So that's a huge risk. So those are the two aspects that you have to keep in mind as you look at the market, the way it unfolds. The third aspect is that historically, to my opinion, regardless of all the other article that I showed you the other day, last 2 weeks of September and the month of October are not that great. And one of the reasons behind that is that mutual funds and hedge funds and all of those people start locking in profits so that they can show performance for the year. So those kind of activities are likely to happen very soon, and they can drop down the market, tax loss harvesting and those kind of things. So keep these factors in mind while you look at the market. It may seem deceptively bullish at this point of time, but it can change on a dime. So keep those things in mind, my friends, and please also share your point of view and thoughts in the comment section. I'm also a retail investor like yourself. I'm opening up with my thoughts, and I would like you guys also to participate in the comment section and let me know what you're thinking. Thanks and have a great day. Bye for now. I'll see you soon.